You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time, once again, for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from a little thing we like to call around these parts, the old Options Insider Radio Network. Yes, it's been around for about a decade now, so I guess it qualifies as old, but it keeps changing, keeps evolving, keeps tweaking, and keeps adding all sorts of new fun stuff, up to 15 shows. You can check them all out, of course, at the mothership, theoptionsinsider.com, as well as wherever you find your favorite audio program, so your iTunes, your TuneIns, your iHeart Radios, your Google Podcasts, you name it, Pocket Casts, and so on and so forth. A lot of podcatchers out there these days. Whatever you use, we're up there. You can even just go to our site if you want and grab our RSS feed for whatever show and enter it into whatever podcatcher you want. For some reason, if their discovery isn't very good in their show, just enter it in manually and you can get it there yourself. Or, of course, you can always just grab our mobile app if that's too much work for you. Available via iOS, Android, and the ever-popular Fire OS. Speaking of Fire OS, you can even just ask Alexa if you have that, the Echo, to play it for you, and they'll play our shows too via TuneIn. So you can get it pretty much anywhere your heart desires, including live every Friday, noon Central, 1 p.m. Eastern for this show, Volatility Views. Love to see you in there via Mixlr, MIXLR, so just grab the link. We tweet it out all the time, every week, and if you're around, you can make it. Maybe you're on your lunch break. Maybe you want to just take a break from what you're doing and listen to some Vol Talk. We got you covered. Check us out over there at Mixlr. Hit us up with your questions or comments. However you listen at the end of the day, we really like to hear your comments. So hit us up via the app or via email or the website or Twitter or whatever you like to use. And send in those questions because we do love to hear from you guys. And joining me on the old program today, starting off, I'm not sure where he's beaming in from. I'm going to guess he's back from the environs of Detroit, but we never know. He is the greasy meatball himself, Mr. Mark Sebastian from Carmen Line Capital by way of OptionPit.com. Mr. Greasy Meatball, welcome back to the program. And where are you beaming in from today, sir? This is the portion of the program where you answer me, sir.
And of course, I'm muted. Of course, I'm muted.
Did you
right
just pull an Andrew? Andrew just did that twice on me this week, and now I think it's an option pit thing. It's literally an option pit thing.
No. I'm coming to you live from our world headquarters in lovely downtown Chicago, kicking back in my beautiful my beautiful office and enjoying watching a little bit of yammering on television and trading them up.
Always good to get a little yammering in the background. Makes some good white noise in the background, I find. And also joining us, Dr. VIX. Can't make it today, called away at the last minute on assignment, as we like to say here in the old network biz. But we found an able stand-in for him, newcomer to the program and indeed to the network. He is Bill Valentine, the founder, I guess, and the principal over there at the Commodore Fund. Bill, welcome to Volatility Views.
Mark, thanks so much. Mr. Sebastian, that was brilliant. I was just looking at my mute button. I'm like, take the mute off, take the mute off, take the mute off, and then talk. That was great. Hey, Mark, good to be on the program. Big fan of Volatility Views. Excited to spend some time with you over the next hour.
I'm glad Mark could give you a good example of how not to go for the rest of the show. So now you've had it drilled into your brain at the beginning. Speaking of the beginning, this is indeed your first time on the program and indeed on the network. So why don't you go ahead and give our listeners a little bit of an overview of your background in the derivatives and indeed the volatility space and what the heck it is you guys do over there at the Commodore Fund.
Yeah, sure, indeed. I'm coming to you from if Mark's coming to you from the world headquarters, I'm coming from the intergalactic headquarters of Valentine Ventures. We're based in fabulous Bend, Oregon, and I've run a firm called Valentine Ventures for 20 years. We provide advisory services in three respects. We have a 401k division. We have separate account affluent investor wealth management. And for the last 4 years, I've been running a volatility-based hedge fund called the Commodore Volatility Fund, where we trade volatility derivatives, both long and short, various measures of vol.
And I have to ask, we used to have someone on our other program I nicknamed the Viceroy. So obviously I like my nautical-based nicknames. Where does the Commodore name come from?
Well, it's a little corny, but my grandfather, who was sort of my hero in life, was the Commodore, which was a position of honor in something in the Twin Cities called the Aquatennial Parade. So he was the Commodore because he was kind of a big shot in Minneapolis back in the 50s. And as a nod to him, well, I came up with the name of the fund. I called it the Commodore Fund.
Well, there you go. I thought you were going to say you were maybe a Rear Admiral or a Commodore somewhere in another life. But there we go. That's also good. All right. And with the team assembled, we're going to dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody. Welcome to the Volatility Review. Like the man said, this is indeed the portion of the program where we break down the week that was and indeed still is from a volatility trading and analysis and activity and trending perspective. Like I mentioned at the top of the show, we are recording this and broadcasting it live on noon Central here, 1 p.m. Eastern on Friday, April 7th, to give you some idea of where we're looking right now. And as we're speaking, most of the major indices are pretty much slightly up to kind of unched on the day. That includes VIX Cash, which is actually inhaling a little bit, up about a little over half a handle. So far, at least, if this keeps on pace, not looking good for my prediction, nor yours, Mr. Greasy Meatball. Looks like Mr. Rhodes in the catbird seat. Dr. VIX not here to claim his victory, perhaps. Except we got a whole hour to go, though, so we never know. We know how this thing can rock and roll. It was by a hundredth of a tick last week that I gave the victory to Mr. Meatball. So we never know how these things can sway at the last minute. But we did have non-farms this morning. A bit of a weird number, a bit of an odd one. A lot of market, usually, of course, keeping its powder dry ahead of non-farms these days. And today, usually, we see kind of the opposite of what we're seeing today, which is non-farm comes out, the market moves in one direction. Usually we see vol come in, that event risk coming off. We're not seeing that today. We're actually seeing some of that more of that risk kind of coming in, maybe because the non-farms Of course, we have obviously developments overseas as well. We'll get to that in a little bit, but just domestically here, of course, the non-farms number was a bit of a weird mixed bag. On the one hand, we had, one of the lowest unemployment rates in many years. Yeah, on the other hand, the numbers of jobs created and everything else kind of well below what was expected. So kind of a glass half full, glass half empty kind of number, and the market always sometimes has trouble digesting numbers like that. And of course, a lot of other things are popping off. Let's have my cohorts now join me to see what they're viewing. Bill, since this is your first time on the show, you are our guest co-host. I will give you pride of place. What is catching your eye this week from a volatility, trading, and activity and trending perspective?
I think most of the interesting things that have happened this week are happening right now, and it's really quite fascinating. I mean, you've got the S&P up 6 bips. VIX is really only 13 and change. And you would have thought, looking at the futures last night, for a while the front month future was trading in the high 14s. Oh, by the way, we just shelled Syria, okay? And Syria's got a really good friend over there that in Russia that told us overnight that it was an act of aggression. I thought for sure we'd be waking up to S&P down 2%, VIX up to the 16, 17s. Pretty muted response, all things considered. In fact, as I look at the comparison of the futures versus the spot rate for VIX, really the only story that continues to play is the French election. You still got the April futures higher than May. I saw something on Twitter today. I can't verify this, but it sounds right. This is the lowest level for VIX, where the front and second month were in backwardation to each other. So it's kind of an interesting situation. I would have thought that the overnight events would have had a bigger play on today. I would have thought that payrolls would. I think people are writing off payrolls to a weather issue or something, saying it's really not an issue. We still have super strong employment, which I agree with. But the story in the VIX market continues to be what's going to happen in April in France.
Doesn't seem to be a lot of mixed signals hitting the market at once. You're right, we did, of course, overnight there was the shelling, the bombing of Syria over there. The market always concerned, maybe usually heads into risk off at a period like this where we have this kind of global political military uncertainty. Add in the backdrop of the non-farms and of course the French elections, and you might think you'd be seeing a different result in today's market, but so far at least not so much. Mr. Meatball, what was catching your eye in today's and indeed this week's volatility action over there at Carmen Line?
Yeah, there's a lot of different pieces. The part I don't get is, why is the April future moving on French elections when French elections expire after the April future? If anything should be moving on elections, it should be that April 26th future, which or the May 10th, which is the follow-up. And both of those remain below April. April seems to have drawn a lot of volatility and a lot of a bid from, we're rallying. Yeah, markets are up. At one point, the S&P was down 14 last night. And I was talking to a buddy of mine. I said, buy this. He said, are you crazy? I said, buy it. We're going straight up tomorrow. And we did. If non-farms weren't bad today, I think we'd be up $10-15 right now. One common misperception is that war brings a down market. We fire tomahawks, and then traders fire green buy buttons, and that's what we're seeing a little bit today. Now, I think that there is a significant chance that coming out of this missile strike, if nothing really happens over the weekend, if there's no more shelling, if nothing happens, I think we could see a pressure release because like Bill said, things are weird. We have a VIX of 13, and yet we've got April trading 1420 and May trading 1380. Meanwhile, June is 1440. So we've got April really reacting violently, while the balance of the curve really isn't doing much. In fact, May's barely moved. So there's something very knee-jerky and something knee-jerky going on in the April futures, and I like that spread in terms of shorting April, long May as a potential trade. I think that spread is completely mispriced, and there's likely a trade there.
what's the saying there? Chaos is a ladder. And the market sometimes responds that way as well when there's chaos around the globe. It's funny you mentioned misperceptions and perhaps myths surrounding volatility and the market. One of the reasons we wanted to have Bill on today is he occasionally debunks some of those things. I think he actually calls it his myth busting of the VIX. No copyright or trademark associated there. I'm sure he's just liberally using it as a satire from the friends. So our friends at Discovery don't come after us for their myth busting. But that said, Bill, this is an interesting little thing. I thought before we moved off VIX Cash, we would get into this a little bit. Obviously, this is a kind of a popular topic. We've touched on some of these in the past. What are some of the more popular and more contentious VIX myths that you like to bust?
Yeah, hey, can I go back to just one thing Mark Sebastian said just a second ago? Is that all right, Mark?
No, not at all. No, of course, go ahead.
And incidentally, actually, before I do that, I got to do one other thing, which I meant to do when I first called in. You've got a nickname for Mark, and you've got a nickname for Russell. Do you have a nickname, Mark?
I do not. People sometimes refer to me as the voice of options, so I let people go with that. But other than that, I have no nickname on the programming itself, no.
No, well, he's sometimes known as the king of the mock turtleneck. And so that's one of his nicknames. But
I'm just watching the news right now, and I'm watching our president, the Chinese president, Florida, and it occurred to me you're maybe Mark Alago.
Oh, there you go. I like that. Now, Bill,
for at least the next 4 years.
Now, Bill, here's my question. Here's my question for you. When you are about to do a trade, you go, "Boy, Valentine's got a sweet trade," and then elbow the person giggling when you do that.
Do I do that?
Yeah.
I don't, but boy, I
need to start doing that. Valentine has a sweet trade for you.
Valentine. Hey, let's get back to the point I was going to try to make real quick. To Mark Sebastian's point, I agree with you, Mark. There's that April versus May trade that you could probably put on, but you got to remember that what the April future in VIX is reflecting is the implied volatility 30 days out on the S&P. So even though this thing's going to expire on April 18th, several days before the French election, the price of implied volatility at that time we forward the 30 days that will cover both the initial election and the runoff in France. So it makes sense that implied vol in April is reflecting what's going to happen during the election. Just in the FYI realm.
Now that we've trounced all over my excellently crafted segue into your myth busting, sir, let's get into it nonetheless. With what are some of the more popular VIX myths that you like to trot all over?
You guys do a great job on this show covering a lot of this stuff, and I'm glad that this information is out there. One of the interesting things is with the explosion in volatility interest in trading, is that there's a continual growth of misunderstanding about VIX, about volatility, and about all these instruments that we're using to trade around those. Now, that's great for me. I trade volatility in the fund for a living. I like taking advantage of this misunderstanding because there's opportunity in there. But at the same time, I don't mind sharing. And I've had this kind of a speech I carry in my pocket I do from time to time. It's a crowd pleaser, and it's called Myth-Busting VIX. And you're right, Mark, I did not buy the rights from the folks at Discovery. So anyway, there's 15 items. We can't cover all of them today. I can just pick a couple of them off there. Here's a good one because it will relate to the VIX guesstimate at the end of the day. And that's that the typical VIX is around 20. The typical VIX level every day since it's traded in the early 90s is not 20. Do you have an idea where that might be, Mark?
It's in the mid or so teens in that range. We've kind of talked about this a lot on the show in the past. We kind of that's been put out there for a while, that this kind of long-term mean of VIX is 20, and I think that's done, quite frankly, a lot for marketing purposes. So then when VIX gets below 20, there's a lot of talk, a lot of action, a lot of people piling into upside calls, so they expect it to revert instantly back to that 20 level. But it's somewhere in the mid to high teens.
Yeah, so you go back to early math class, right? We learn three measures of typicalness. One is mean, one is median, and one is mode. And all my life I wondered, what would you ever use mode for? You remember the definition of mode? Mode is the number that appears most frequently in a group of numbers. In the VIX case, mean, which is the average, which of course is skewed by those extreme spikes, is 20. The median, which is a better normal typical measure when you have outliers, is closer to 18. But the mode, interestingly, is 13. So you could make the case that if somebody had a gun to your head and said, I'm going to randomly select a day from the history of VIX, and you got to tell me what the closing level of VIX was that day, your best chance is 13. In fact, fully 33% of all closes or all ending levels of VIX is between 11 and 15. So it's kind of an interesting way of looking at it. And you're right, people use the higher level of VIX to make notions about undervaluedness, and they make all sorts of statements, and this is actually another mythbuster that we can talk about later, that implies that VIX is a stock. So you see people put technical analysis on top of VIX levels, and you see people talk about how undervalued and overvalued and how it's going to pop. It's not a stock. It's not even an asset. It's a measurement, right? And lowness doesn't create highness when it comes to VIX.
Yeah, you're right. Though that's another thing that's been put out there quite a bit is, this is volatility an asset class on its own. A lot of people look at it different ways. I think we on the show have kind of pretty much not really agreed with that notion because it is so inherently derived, literally, from another asset that it's kind of difficult to look at it on its own. Another one I thought on your list I thought was kind of interesting was actually number 2, which is shorting vol is a crowded trade. The reason I thought that was interesting is because people have been hitting us up quite a bit of late. So maybe this is. Maybe this is more fuel for the fire of your myth here. People have been hitting us up and writing in, sending in charts. Most recently, a couple of weeks ago, a little bit less now, but it was very high a couple of weeks ago. It seemed to be peak short VIX panic, sending in charts about net short VIX futures positions and how heavily we even talked about it a couple of weeks ago at RMC about had VIX and had the market effectively reached peak short volatility supply, for lack of a better term. What does that mean for the market? But it sounds like you're here to bust that myth on your list.
Well, I'll look at it 3 very simple ways, and we can go into greater detail if you want. In the very, very simplest way, if you compare the trading volume in VXX versus XIV, you still see essentially 2-to-1 VXX trading versus XIV. Now, people are shorting VXX, and they're also shorting XIV. It's not a perfectly clean argument, but being long volatility is still more popular among sort of the pedestrian crowd than being short volatility. Is short volatility an under-discovered opportunity? Heck no. It's out there. As things currently happen, probably is only going to happen this way. This opportunity that exists, which has really favored people short on the vol side for the last several years, that's going to come to an end. It'll probably come to an end in a really ugly way where we'll go against people and we'll wipe a whole lot of people who are short out and that sort of thing. But yes, there's a lot of interest in shorting vol, but it's still not at the point where it equals that of being long vol. The second thing is when,
Bill,
go ahead.
I would throw out that if being short vol is a crowded trade, then no one should be long the market, because when you're long the regular market, you're short vol, and so I agree with you wholeheartedly.
No, it's exactly right, brother. It's exactly right. It's the same thing. It really is the same thing. When people get that, it changes their perspective. The second thing I would say is the 2 things that you're seeing quoted now about justification of this concept that the market, that the short vol trade is crowded, is one is this massive short futures position by speculators. But the thing you got to remember is there's a trader against that for every trade by the non-commercial in the COT measure of commercial traders of the futures. You got the speculator, but you also have the professional trader. So there is no such thing as a net short position in futures because there's another person on the other side of that. The third thing is that there's a huge short position in VXX, undoubtedly. If you look at the options against VXX, there's a massive short position. But days to cover is only like 1. So I hear these things about, there's this massive short position in VXX, and once it moves against it, it's going to crush everybody. I'm like, you got bigger short positions on a days to cover basis in most tech stocks than you have in VXX. So yes, there's a huge short position against VXX, but that doesn't necessarily mean it's going to cause an extraordinary dislocation between VXX and the futures, because ultimately the authorized participants can hedge that away. So the short position in VXX is not necessarily an indication of an overcrowded trade, and it's not necessarily an indication that VXX will dislocate from the futures.
And since you're talking VXX, let's hit on that for a second here, because you have a couple others on this list, and VXX obviously a hot product, hot topic whenever we bring it up. You have a couple here. You mentioned the VXX holds VIX futures as one of the myths you want to bust. You also, this is a contentious one we've discussed and debated at length on the program. You say VXX decays because the role is, of course, selling low and buying high. We've had numerous people write in to debate that topic. We've debated it many times. We probably could spend a whole episode and a half on the exact nuances of what the heck is causing that role. But nuances aside, what are the myths you want to bust about VXX?
Well, the first one I'll go back to that you just mentioned, I'll touch briefly, and it will probably be disregarded by most of our listeners. But it's an extremely important point at precisely those moments in time that we care the most, and that is that VXX holds VIX futures. It does not hold VIX futures. VXX doesn't hold anything. VXX is a bond. In fact, it's a derivative bond. I call it, believe it or not, VXX is a derivative of a derivative of a derivative of a derivative of a derivative. And if you think about what VXX is trading based on, you'll find all five of those links that ultimately go back to the S&P 500. So the assumption, and this is the difference between an exchange-traded note and an exchange-traded fund, the assumption that what you're buying in VXX is backed by collateral is not true. It's backed by the full faith and ability of Barclays to make good on a note that's, oh, by the way, coming up in 2019, I don't know if people realize this, the note, which was the issuance of VXX, Barclays has complete discretion over how much it wants to hedge against movements in vol futures. So it's just really important to understand. I mean, nobody reads a prospectus, right? I had the misfortune of reading the VXX prospectus as well as some of the other ETFs and ETNs. You just have to understand that you don't own anything when you own VXX other than a bond. To the second point, what was the second point that you asked me about with
about the negative roll yield out there in VXX?
Oh, yeah. So you can have a situation like we had yesterday, where the front month future and the second month future are equal. Okay, if those two futures are above volatility, above the VIX spot itself, you can have, so essentially, the terms backwardation and contango get thrown around incorrectly a lot when you look at people talking about futures and volatility. But let's just say that there's no backwardation or futures between the front and second month. You can still have decay in the VXX in that situation as both of those futures come down to meet VXX. So it's not necessarily that you hear this concept of, well, the front month is lower than the second month, it's buying low, selling high. No, it's not. It's the 30-day point in time sliding down that curve towards VIX that creates the decay. It's not the relationship of the front 2 months for each other. Put more extremely, you could actually have backwardation, front month higher than second month, and be decaying every single day as those two futures slide down towards VXX, which is what happens to create the decay.
I said this is an interesting topic, and we probably could spend, I think, quite a bit of time on it. We have in the past. But the other thing I wanted to get on really quickly on your list, because it mentions, and getting again to VXX, a lot of people's favorite volatility trading product, is the notion, where is it here? Oh, you don't mention VXX specifically, but you say you shouldn't hold a VIX ETP for more than a day. Now, obviously, broadly, that's not true, because there's a lot of different flavors, as you just pointed out, of VIX ETPs out there, but VXX itself, I'm sure you probably would agree, isn't ideal as a buy and hold vehicle, but others out there are a little bit better suited for longer term. Well,
this is a great, this in and of itself is its own show. You're right. There are other ETPs. Great ones would be like the ZIV, which is the medium term short VIX future ETF. Like Mark said earlier, it's basically the market. I mean, you're basically long the S&P when you're doing that. And it has some of that decay that takes place in the VXX, and over time it provides a pretty good return. It has some steep sell-offs, but nobody's screaming you shouldn't own that for more than a day. The thing about VXX owning more than a day, if you say you shouldn't own VXX more than a day, then you should never own a put option more than a day. I mean, VXX is just an expensive form of hedging, just like any other form of hedging is. So if you want to hedge for a month and you own the VXX for a month, there's nothing unreasonable about that. Is it going to decay? Yeah, but you're not picking a stock. You're not picking something that you hope will go up. You're picking something that should have a convex reward if there's a major sell-off. But the notion that you shouldn't hold some form of insurance more than a day is just one of these confusions people have between what VXX is, which is a hedge, versus the notion that it's some investment like a stock that's supposed to grow over time. It's not.
I can agree with part of that. I think the issue I would take with that is that, the decay, the erosion you're going to get in, let's say, a SPY or SPX put is clearly delineated, is quantifiable. There's theta. You know what you're getting. So you kind of know obviously it can evolve, but going ahead of time exactly kind of what you're getting. VXX, as we just pointed out, not so much. That erosion, a little bit more, shall we say, in the ether. It's coming, but exactly how and where and when it's going to unfold, a little bit more unpredictable in that sense, even though I think Rock Lobster refers to it as predictably crappy. I think the crappy part I can get behind. So you still think those two as equivalent, like an SPX put and just VXX?
Well, let me let Mark chime in.
Yeah, let me chime in here. Mark, what I would say is it's very similar to holding a SPX put option, but maybe the strike is a little bit of a moving target. So, but I think that you're kind of both right. Yes, if you looked at the cost of owning VXX, it's very similar to the stream of holding a rolling put position. So, whereas I would say that a standard SPX hedge or a hedge directly in VIX will produce something that's a little easier to read. The payout of VXX is entirely similar to that of a rolling put position, which is what I think Bill kind of really meant by the way he was describing things.
No, you exactly. You quantified it exactly. That was going to be my put. Like a put spread against the S&P that you're rolling every 30 day has an unknown level of decay. It has an indefinite life. It's like the VXX. Now, I'm not endorsing owning the VXX as a hedge. I'll be quite frank. I'm short a whole bunch of shares of it right now. I think it's a very inefficient way to hedge. But the notion that the investor that's using it for more than a day is any more irrational than somebody who's putting on a 30-day put spread, to me, it's just a misunderstanding. And I just don't agree with the notion that it should be used for only one day at a time.
I just get leery when we start going down that road because I know in the back of my mind, and these people are out there en masse, which are, the proverbial grandmothers from Iowa who have learned about VIX from a handful of viewings of CNBC, and they think I want to get some of that VIX for my IRA or my 401k or whatever it is, and then they go out and buy VXX and they kind of set it and forget it and set it away in that IRA, and the next thing you know, a couple of years later, they check on it, and lo and behold, it has eroded substantially, and not perhaps in the way they wanted. So that's why I get a little concerned. I concede your point, and I think the notion of the rolling kind of put strike is a little bit more apt there. But I see your point, even though I do get a little concerned, because once we start going down that road, next thing I know is going to be people writing in and hitting us up and saying, I owned it for a day and a half and I got crushed. And Bill, I will send those emails to you when they come in, sir.
Yeah, please do. And that's going to happen. And, of course, that's not my point. My point is not to endorse it, but just to say there's all sorts of things people can get in trouble with, right? ETFs and options and things that people do all the time. So I'm not endorsing ignorance. You have to understand what you're doing. But in a very simple sense, VXX for more than a day does have at least some rationale to it.
There you go. Bill Valentine endorsing wholeheartedly VXX. Mark, before we wrap up on these myth-busting, any questions or issues or things you want to point out that sprung to mind?
Yeah, I think that, this goes to when we have the Thompson twins on, kind of the back end of this discussion about the fact that volatility tends to swell before it spikes. And, you could look at today and what is going on and say maybe that's a swell. I think that there are a lot of smart ways to hedge, and yes, I would agree with Bill. I don't endorse using VXX, and it's scary when news anchors talk about it. I've had to correct news anchors on air saying don't buy this unless you're an expert. But I think Bill hit a lot of myths, and in terms of the roll yield, if you think about what Bill was saying, imagine buying a future and then buying a basket of 1 month of futures over a 30-day period. Then over the next 30 days, as it heads toward that cash level, it's unwinding a little bit of its position every day. That's really what creates that decay. It's not the concept of, well, I'm buying low and I'm selling low and buying high. It's that I'm buying high, and then as it's coming off, as those futures are converging, I'm slowly unwinding that high position. So it's not the selling one future and buying another. It's actually the unwinding of one single future that creates the VXX quote-unquote roll yield.
That's exactly right.
I think there's a lot here. We probably could spend the rest of the show on this, but I think the another salient point that you made that I think is worth repeating was the notion, and we brought this up about a lot of different ETPs, and it's the same for all of them, is the devil is very much in the details. I thought your point about the note there for VXX is a really good one. Especially the fact that it's expiring in the next couple of years. I think a lot of people come to this, and you're right, they don't read the prospectus. They have no idea really what the heck they're getting, that they're really just getting this thing that is backed by the full support of Barclays. And we all know there's no real thing as counterparty risk out there, right? I mean, Barclays is going to be around tomorrow, right? We don't have to worry about that, right? So just
Mark, if I can chime in on this, when Lehman went under, it took 3 ETPs with it, and those people, I think, to this day are still waiting for their payout. Last I heard, it's like 11 cents on the dollar, and these were ETPs that were backed by stocks, right? So it's not like the underlying imploded. Lehman imploded, and a month before that happened, who would have thought those ETPs were at risk?
That's a great point. Like I said, these are backed by essentially a liability on Barclays, not even a stock. So that's going to go the way of the dodo. The second, if it does happen, we do see another Lehman. I'm not implying that it will, but of course, if we do see that counterparty risk actually materialize in Barclays, you may, even though you're trading this widely traded, exchange-listed product, again, we said this many times, the devil is in the details in these VIX ETPs. This is interesting stuff. I think we'll probably get back to some of these. We got to keep rolling with the rest of the show now. Let's get into, really quickly, we've been talking a lot recently about skew here on the show and some of the merits or perhaps lack thereof, depending on your viewpoint on the old skew index. This was all prompted, of course, by the recent spike about 2 weeks ago or so out there in the CBOE Skew Index, a spike to about, I believe, 154. There was a lot of debate and back and forth about what that meant and what was even causing it. The initial first blush on that is, of course, hey, people are buying puts. Then you dig into it a little bit, you actually see the call premium a little more deflated than normal, hence a higher skew level as a result. So there's a lot of moving parts to all things skew. If you're interested in that, by the way, listeners, we did a great debunking of that on our TWIFO program, which will be coming up again after this show. So check that out in the archives if you haven't done so already. Now we're seeing skew back down to somewhat, I guess you can say, normal levels around the 130, 131 level. Normal, I think, is usually around a 125 or so, which is, of course, how they quote that, listeners, 125. Again, because those puts usually have that premium out there in the SPX. I don't know, Bill, we haven't had a chance for you to weigh in on this. Curious your thoughts. Do you pay attention to the skew index? Do you find it a meaningful indicator, or is it kind of just more noise out there in the ether for you?
Nope, look at it every day. I think it's very revealing. I think everyone, if you're going to trade volatility or follow volatility, if you're even going to participate in the markets on an active basis, you got to follow skew. And you're absolutely right. Sometimes it's driven by the relative increase in the price of puts that are further out of the money as a measure of, call it tail risk fear. But sometimes it can be a lack of interest in calls, which I think that's essentially the same thing. A lack of interest in calls is a diminished interest in euphoric optimism. But it is a very, very important measure of the relationship in the kind of the psychology of traders. And I think it's also very important because when skew's at 150, regardless of its the genesis and the cause of that, it's reflecting something that I've been saying and really has been falling on deafening ears since the election, which is that just because VIX is low doesn't mean hedging is cheap. The spread between implied vol and historic vol since the election has been extraordinarily high, meaning that anybody that's been hedging has paid a huge premium relative to their payout. The ratio of the spot VIX to 7 months out future, which is sort of the metric for long-term hedging, long-dated option buying or long-dated futures buying is a hedge against the market. That spread's actually very high, or has been until just recently, very high, and skew when it's high. All three of those say low VIX is not necessarily an indication of hedging interest or tail risk fear. There is a lot of that out there today. It's just not reflected in spot VIX.
Yeah, that's a point we've made many times on the show. There's this belief just because VIX is low, things are cheap. But you got, like we said on the show, just like I believe last week, all volatility components have a context, and you have to look at them. And if skew is high when VIX is low, it's still going to cost you. It may be net cheaper than it was if VIX at a 20, but still calling them cheap, perhaps not so much. Mark, any other thoughts there on skew before we move on to all things VIX options?
I'm not sure if I need to restate exactly what Bill. I agree with Bill, and we've gone into I think we've gone into depth on what I feel like skew represents and what it means.
You two are no fun. No point counterpoint on here today. I'll see if I can rile you guys up in a little bit. Let's move on. Meanwhile, no Russell, of course, so no Russell's weekly rundown. I apologize for all of you out there, including myself, who really love that transition for that segment. Instead, let's dive right on into the meat of all things VIX options, lighting it up this week. Another moderately active week. We had one or so day above the ADV. That ADV continues to creep up, listeners. We've said this before. It got below 600,000 towards the end of last year, but then slowly started creeping up. Pretty much all of 2017 is now we're back up to about 660,000 ADV, which is, I think, an ADV, quite frankly, most options on the planet would kill for. And VIX kind of does it at a whim. Yesterday, about 564. Let's see how we're lining up so far here today. Actually, a fairly active day. Again, non-farms driving a lot of action out there. Already nearly 900,000 contracts going up today. So looks like we're on pace to hit about 1 million today, at least nearly 2-to-1 calls over puts going up out there today. The other big day of the week was Wednesday with about 720,000 contracts. The rest of the week kind of hovering a little bit about that, or around that ADV level. Overall, VIX, despite today being 2-to-1, overall VIX is still fairly light from an open interest call heavy perspective. VIX can get up 4, 5, 6-to-1 very easily. Calls over puts these days only about 2.5-to-1. So pretty much in its normal range. Let's get over to our number one with the bullet here, our top 10, our hot VIX strikes for the week where people are actually playing out here in VIX land. And it may surprise you to know, number one with a bullet this week is a put. It's been a while, but we have seen more put activity in the last couple of months. Puts have slowly been making a resurgence here on our top 10 list. And this week, once again, April puts, this time April 13 puts, number one with the bullet, 358,500 contracts to be precise. So all of you writing in about VIX put call and other things like that, and why don't VIX puts get any love? There you go. VIX puts getting some love today. Number two, hot on its heels are the APE 20s. The APE 20 calls, 357,000 and some change there. Number three, the APE 18s with about 319,000. Again, hot right behind it, the number 4 spot, the APE 15s with about 316,000. Number 5 is our second put on the list, the APE 12s. APE 12s and APE 13s lighten it up with 310, nearly 311,000 contracts on those APE 12. So if you were saying puts were hot in March, are they still hot in April? The answer so far is a resounding yes. Number 6, the APE 17s with about 305,000 contracts. We're over 300,000 all the way down to number 7, which is interesting. The May 20s, 303,000 contracts. That shows again how active and robust these popular strikes have been. Number 8, the APE 23s, 256,000. Number 9, the APE 19s, about 250,000, right around 250,000. And number 10, bringing up the rear, the APE 25s. Again, we've said before, the 25 is the new 30. No love for the 30s yet again. 243,000 contracts. Rounding out our top 10, about 9.8 million contracts open. That's a fairly hefty amount here for VIX. About 7 million on the calls and about 2.8 million on the puts. Before we roll off, pun intended, from VIX options, any other activity out there in the VIX options mothership catching your eye, either Mark or Bill?
Yeah, we had a big call buyer come in this morning buying May 20s for 57. He bought 25,000. Maybe it's our. By the way, if I hear one more story, all right, I've now got 2 VIX complaints. One, I'm sick of quoting whether I want to buy a put to sell a call spread. It's getting overdone. 2, if I hear the word 50 cent relating to our friend that our group of friends, not a single friend, our group of friends that is buying 50 cent options to hedge off some portfolio, I will also kill myself there, or I'll also break something. But big trades that we saw today, we saw a big seller of the 15-16 call spread. 20, I believe, 5,000 traded. They were cross-sold, customer seller. We saw a customer try and buy the April 27 calls for a nickel. The 13.5, 17 call spread traded 85 cents tied up. So lots of call buying, but the 2 big trades we saw was the call buyer, the May 20 calls, and then this April call spread seller. To be fair, kind of like that as a package, selling the April call spread to finance a May call. Not a bad little trade. And there you have it.
All right, Bill, any other activity catching your eye before we roll on? Getting a lot of questions. I want to get to some of those too. People liking the discussion here so far. But Bill, any notable VIX options activity catching your eye this week, or should we keep rolling?
No, just real quick, as you guys rightly point out, the 30 strike VIX call is such a popular trade. It's 4-to-1 volume open interest versus the 29 or the 31, which is kind of funny because what's the explanation? It's because 30 is a round in number. That's why people seem to buy it so much. Personally, if I was to buy a call that far out, I might look at 29 just to be outside of that. That'd be a little bit contrarian. But as you said, didn't show up in the top 10 strikes in terms of trade volume today, and I think that's kind of surprising.
Yeah, our beloved 30s and much bemoaned 30s not making the list anymore. But making the list though are you guys hitting us up with all kinds of questions. See how many we can get to in our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, here. Got a lot of questions. You guys have emailed in and chimed in and social media'd in and actually live tweeting in and asking in the chat here during the show. So I'll see how many we can get to them. Let's start off. I like to give you live guys some love. So let's start off with you guys. VTrader168. He wants to know V-Stock's volatility. He says the V2TX is quite high as compared to VIX. Is it possible that VIX is undervalued? Well, not surprising that we'd see V stocks getting a little bit of a bump in these days when a lot of people, depending on who you talk to, are parsing out what little VIX premium there is right now. A lot of it being derived, of course, by events overseas, in particular in the Eurozone, that's V stocks' bailiwick. That's where they play. So if you trade V stocks, you want to get that European premium. So it doesn't surprise me that that V stocks, or in particular this V2 TX is, I'll have to pull up this one to see exactly what that one is, but in general, that one would have a bit of a premium. I don't know, Bill, you're our guest. You get pride of place here. Do you play it all in V stocks? Do you watch it? And what do you have to say for our friend here, V Trader, who thinks maybe given the premium he's seeing out here in V stocks, maybe VIX has got a little bit more room on the upside to run?
Okay, so I'll keep it short. I don't play in V stocks currently. I do follow it. I think it's entirely the French election. The spread between the implied volatility on European equities is higher, or there's a spread over the implied volatilities on options in the U.S. Naturally, because who's going to react more negatively or positively to the outcome of the French election, Europeans or Americans? European markets, clearly. I mean, there's a beta of European markets to U.S. markets of 1.5 anyway. So regardless of what happens, the higher implied volatility in European stocks makes more sense, and that's exclusively the explanation. I don't think you can hedge that by being long one and again short the VIX. I mean, short V stocks versus the VIX. I don't think that's worth playing. They're both going to move in whatever direction. when the outcome of the election is known, which won't actually be until May 5th. But interesting to note that Le Pen is back in front, and she's the wild card against which the hedging is taking place.
Mark, any thoughts on V stocks versus VIX right now?
I think Bill is dead on. And like I said, I think this uptick in the regular April future is misguided. And what's interesting is I think V stocks, the April future is also kind of bid relative to May, and that's not when the election is. I've been trying to figure out what's going on there, but it just doesn't seem to make a lot of sense to me.
We've also got in the chat here, Sakib Reports asking about a journal article. He wanted to know what we thought about this story. He talks about money managers' growing use of insurance against sharp market moves, keeping vol near historic lows. Unfortunately, on this computer where we're broadcasting from here, Sakib Reports, I don't have access to the journal. This computer is not logged in, so I can't actually read that article to see exactly what they're talking about. So unfortunately, we won't be able to discuss it right now, but I'll try to queue it up for you. Maybe on Monday's option block, we can get into that a little bit. I need to be able to see what the article is talking about first before we can coherently and cogently discuss it. That said, we got a question here. This comes in from LVT asking about what we talked about on last week's show, where we kind of discussed technical analysis in and around VIX and the use case or perhaps lack there. Obviously, in a lot of articles, a lot of people talking about moving averages and VIX and things like that. And the use case, he writes in and says, I think that moving averages are worthwhile when analyzing VIX. Other than that, not so much. Interesting here. This is kind of a point. I don't know, Bill, first time on the program. I haven't had a chance to get your opinion of this yet. What do you think about, in general, the application? Is it misguided, or is it perhaps prescient to try to apply traditional technical analysis techniques like moving averages or Bollinger Bands or whatever to a product like VIX that is kind of its own beast? Do you think they're worthwhile, or do you think it's kind of a fool's errand?
Yeah, with due respect to the person who asked the question, I don't have technical analysis in my DNA. I don't have a lot of faith in it. I think a lot of it's heuristics. It's a lot of epiphenia, which is when you make a meaning, you derive meaning from random lines and information. And I think it's even less valuable with VIX, because one of the misconceptions people have is that VIX is a behavioral asset, that it's going to be traded, that when it's down low it's going to bring in buyers, and when it's up high it's not. It's a measure of implied volatility in the S&P. So if you want to technically analyze the S&P, that's one thing, but I don't think you can technically analyze VIX. That's my own opinion. On the other hand, moving averages are a perfectly fine way to put in a risk management tool. If, for example, you're short vol, put in a risk management tool. If you break through your 200 or your 50 days, a way of saying, okay, I'm going to cover my position, that probably spares you from the worst damage. I just don't think it's a particularly good tool to add a lot of value day to day.
I could not agree with you more, Bill. I think especially with a product that has some natural mean reversion, maybe that. I do see some people play around with RSI on it a little bit, but I think that to try and trade VIX off technical analysis, or really even VIX futures, is a fool's game and a folly. It is a huge mistake. So I agree with you, Bill.
I'm going to have to find another guest where you don't see eye to eye as much. This is just a love fest here on the old Volatility Views. I'm joking, of course, Bill. We'll try to have you back unless you can generate some heat next time. But that said, of course, we got a lot of questions. Unfortunately, we read them all. We can't answer them all on the show because we got to keep rolling into our final segment. Keep them coming, though. We'll try to squeeze them into this program or to others if we can squeeze them onto this one. We've got to keep rolling into our final segment, the Crystal Ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the Crystal Ball.
All right, welcome to the Crystal Ball. Like the man said, this is the portion of the show where we attempt to wrestle that unwieldy beast that is VIX and try to get it down and lock it down for a prediction. And I got bad news, Mr. Greasy Meatball. Not looking good for you. Not looking good for me either. Today, I was hoping at least, for a little bit of a measured sell-off in VIX coming throughout the hours so that my prediction of a 12.5, we had a record time last week. I don't think we've ever had it where all of us kept our predictions exactly the same from the week before, but that's kind of the week it was. It was a bit of a head scratcher. Not much of the indicators seemed that different, so we all literally kept our picks the same. I stayed around 12.5. You stayed at 12. Mr. Russell picking 1280, and as of right now, we're right almost exactly at that level, right around 1283. So Mr. Rhodes figures he misses the day where he actually wins. It's a rare occasion. I think Mr. Rhodes had like 3 victories, sum total, all of 2016. So he should be here to celebrate triumphantly. Instead, unfortunately, he is not. But that does open the door for you, Bill, as our guest. You get pride of place. You get to pick first. I don't know if that's I like going first, but some people think it's a dubious honor. But that said, I shall bestow it upon you nonetheless. What do you think this time next week, close of the Ball View show, so right around 1 p.m. Central, where will VIX Cash be, sir?
Well, I hope I made an impassioned case before about why typical VIX is not 18 to 20. Typical VIX is the mode. It's 13. I'll chicken out my first time on the show and say with put the statistics in my corner and say that VIX is going to be virtually unchanged. It'll be at a level of 13, spot 00 at this time next week.
Interesting, 13 even. I think if Russell were here, he would be rolling over in his proverbial grave because he likes to be the high VIX picker. But I think you might have him trumped here this week. And since you two see eye to eye, I should just put down 13 for Mr. Greasy Meatball too, because you two are just simpatico on everything on the show today. But that said, Mr. Meatball, what are you feeling for ye old VIX Cash next week?
12. Right back to once we came, baby.
You're right back. All right, broken records. Broken clocks. Gotta win at least twice, right? So there you go. The ghost of Mr. Rhodes is not here, and we know he's a degenerate volatility buyer. So that means his ghost is going to be selling vol very hard. I think he's feeling a single-digit VIX of Mr. Trump. So he's going to go for a nice 9.87, which I know he will appreciate en masse. And now I got a nice little strangle ahead of me, a 12-13 strangle facing me in VIX Cash. I think we're going to be a little bit lighter. I don't think we're going to be shy of the 12 handle, though. Not with all this unknown popping off overseas. I don't know, 13 handle. North of 13 handle is also fairly aggressive. I don't want to be the exact same place I was last week, though, because that's no fun. So let's go. I'm going to move myself a little bit north. I'm going to say 12.65. There we go. All right, listeners, the team has spoken. The volatility gods, we've made our sacrifices. We shall see how the volatility gods, what they hold in store for us in the coming week. Meanwhile, that music means we've come to the end of another epic journey through the world of volatility. We touched on VIX and the many, myriad, indeed the legion of myths floating around that can be busted about VIX. If you have views on those, and I'm sure you do, just from what you were chiming in during the show, hit us up. We'd love to hear from you guys. We try to squeeze as many in as we can. Sometimes we get derailed by fun conversations like today, but I think it's worth it. I think you guys will agree as well. But before we go, let me check back in. Mr. Bill of your Commodore Fund there. If listeners are interested, they want to hear more about, let's say, busting myths, or they want to reach out to you on social media, or maybe they want to invest in your fund or do something with your fund, where should they go? What should they do?
I think you just follow me on Twitter, at B Valentine CFA. That'd be the best way to go. And Mark Alago, it's been a pleasure to be here, friend. Thank you so much. Mr. Sebastian, good to talk to you as well. You know, Mr. Sebastian's agreeing with me is only a sign of his intelligence. Let's not hold it against him.
Yes, you can always tell a brilliant man because he thinks the same as you. Mr. Meatball, same question for you, sir. What's going on in the world of the pit these days?
Oh, lots of fun stuff. Just read our blog, optionpit.com/blog, and you can bask in all my brilliance.
There you go. Bask away, optionpit.com, or give him a follow over there on Twitter at optionpit, or indeed his cohort over there. Also a fan of the mute button at optionvol, Mr. Rock Lobster. And on behalf of Bill and Mark, and even the ghost of Russell is out there somewhere, and indeed myself, I want to thank all of you out there for downloading and streaming and subscribing to the show. And of course, for all of you who tune in live and ask questions and everything else, we love you guys too. And we'll see you next time right here on Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.